Welcome back to the Deep Dive. Today we're diving deep into a world where precision is, well, it's everything. Algorithmic trading.
It really is.
And you tasked us with tackling what is, I think, arguably the single most critical and yet so frequently overlooked failure point in strategy development.
Overfitting.
Overfitting, also called curve fitting.
Right. It's the silent assassin of trading capital. And what makes this deep dive so interesting is the framework you brought to us. We aren't just talking about the idea of overfitting. We're using the really rigorous, statistically grounded process of Six Sigma to transform this huge financial risk into a measurable statistical defect.
Exactly. And for anyone who's been in this game, you know what this is. Overfitting is when you create a strategy that is so perfectly tailored to the historical data, the in-sample data, that it looks like a work of genius.
It looks perfect.
But because it's fit the noise, the random flukes of the past, rather than the underlying market structure, it just completely implodes the second it meets new out-of-sample data.
It's a flawless model for a history that's never going to repeat.
Right.
And if you think about this from a quality control perspective, which is what Six Sigma is all about, that failure, that's a design flaw. It's a systemic lack of robustness.
So our mission today is to follow that Six Sigma playbook: define, measure, analyze, improve, and control to figure out exactly how we quantify this failure.
Using metrics like DPMO, defects per million opportunities.
Okay, so let's start at the beginning. Define. In manufacturing, you define a defect by setting specifications. Right? If a part isn't within tolerance, it's defective.
Yep.
So when we're talking about designing a trading strategy, what's the specification we're missing when we overfit?
The spec we care about most is robustness. I mean, if a strategy passes a perfect backtest but then fails in live trading, or it just collapses when market behavior shifts even a little bit,
It's defective.
by definition, it is a fundamental design defect. It failed to meet that critical to quality requirement of translating historical success into predictive reliability.
So a defective strategy is one that looks great on paper, but is just brittle in the real world. Now, to bring in the Six Sigma math, we need to define the opportunity for that defect to happen. What's the unit of measure here?
And that's the real pivot point for applying this framework. The opportunity is every out-of-sample test cycle you run.
Every OS test.
Every single one.
Yeah.
The OS test is your ultimate statistical integrity check. You withhold a chunk of historical data the model has never seen.
The stuff it wasn't trained on.
Exactly. And you run the strategy on it, and you just see if the performance holds up.
So if I build, say, 10 different versions of a strategy, and I run 10 separate OS tests, then I have 10 opportunities for a defect.
10 chances for it to fail.
10 chances for the model to show that it only works on the data it was trained on.
Precisely. And if, say, 2 of those 10 OS's tests fail, meaning the performance dropped significantly or even went negative, you have 2 defects out of 10 opportunities.
Which is a 20% failure rate.
Yeah, and statistically, that is catastrophic. And this moves us right into the measure phase.
Okay, so measuring this failure moves it out of that realm of just, subjective disappointment and into quantifiable risk.
Using DPMO.
Right, and we're aiming for near perfection, a Six Sigma process, which tolerates only, 3.4 defects per million opportunities?
That Six Sigma benchmark is the North Star. And the rigor of just aiming for that forces us to be incredibly critical of our whole design process.
And the defect we're measuring is simple.
It is. It's the strategy failing to achieve comparable performance on the OOS data compared to that, rosy in-sample data. If that performance divergence happens, that OS cycle is a failure, a defect.
And the DPMO calculation just formalizes that risk across every single validation test we run.
Exactly. We calculate what we call DPMO for overfitting by taking the number of those OS failures, dividing that by the total number of OS tests we performed, and then we just scale it up to defects per million.
So if your firm runs hundreds of these tests a year and your DPMO score is high, maybe in the tens of thousands,
it tells you your design process is systemically flawed. You're constantly creating strategies that look viable but are actually just ticking time bombs.
Okay, I have to inject a little bit of skepticism here. We are dealing with the absolute chaos of financial markets, not a controlled assembly line. Is aiming for Six Sigma 3.4 defects per million, is that even achievable, or is it just a philosophical target?
That is absolutely the right question to ask. And for market prediction, true Six Sigma might be impossible. We just can't control the input variables, the market itself.
Right.
However, Applying the framework is what matters. The goal isn't necessarily to hit Six Sigma DPMO on every strategy, it's to use that DPMO score as a gauge of our internal process integrity.
I see. So it's about the quality of the process, not predicting the market perfectly.
Exactly. If our design process is working at a 4 sigma level, it means we're building robust strategies most of the time. If our DPMO shows we're at 2 sigma, we know we're essentially just gambling. The rigor applies to the methodology, not the market itself.
That reframing helps a lot. It's about auditing the quality of the builder, not the market.
Uh,
Okay, let's move to the analyze phase. Why are we getting a high DPMO score? Why does this brittleness even happen?
Well, the root cause is really the human element, driven by the data. We inadvertently optimize the model to fit the random noise in the data, the temporary fluctuations, the one-off spikes, instead of the stable underlying structure that will hopefully persist.
It's like trying to predict the weather for a specific week last year and mistaking one unusually sunny Tuesday for a fundamental climate shift.
That's a perfect analogy. And this is where that famous warning from Enrico Fermi is so relevant. He observed that with enough parameters, a model can be fitted to any historical course.
If you allow too much complexity, you'll always find a perfect fit, even if it's meaningless. So let's break down the critical causes that lead us to build these defective systems.
Okay, so the sources identify 3 key contributors. First, excessive complexity. Analysts just add too many bells and whistles, too many moving averages, conditional clauses, arbitrary filters.
Piling on parameters.
Yeah, and every single parameter you add increases the chance you're fitting noise, not structure.
And the second cause.
Statistical inadequacy. This one is so vital and so concrete. You might have years of data, but if your strategy only makes a handful of trades in that time, your sample size is just insufficient.
Right.
The sources are very clear on this. For the average trade result to statistically converge and give you any confidence in its stability, you need to accumulate around 100 trades in the OOS test.
100, wow.
If you launch a strategy based on 15 trades, you are relying completely on luck.
That is an incredibly important metric for you to take away. 100 trades minimum for statistical confidence. That forces a lot of discipline.
It does. And the third cause is low detectability. This just means your current validation methods aren't strict enough. They aren't designed to find subtle overfitting.
So your tests are too easy.
Too lenient. They pass systems that are highly brittle, which keeps your actual DPMO score high, even if you think you're being rigorous.
So we've defined the defect, we've measured its frequency with DPMO, and we've analyzed the causes of complexity, poor sample size, weak testing. That brings us to the most important phase, improve and control. How do we reduce that DPMO score for good?
First, we have to prioritize the risk. Using something like FMEA failure mode and effects analysis, we recognize that overfitting has catastrophic severity. It leads directly to capital collapse.
So its severity score is a 10, maximum.
It has to be. And because the consequence is financial ruin, this risk automatically becomes a #1 priority for improvement. We have to focus all our resources on prevention.
Okay, so we target those 3 causes we just identified, starting with sample size and OS data.
Right. We enforce the fundamentals. Strict separation of OS data and sticking to that 100-trade minimum for convergence. But the truly effective improvements come from increasing the rigor of our detectability. We need to make the tests harder.
Which means focusing on robustness and sensitivity testing.
That's it. This is where we ensure the strategy isn't, married to a single delicate parameter setting.
It has to prove its edge comes from something real.
Yes, an enduring market anomaly, not from finding the one magical parameter setting that worked perfectly back in 2018. If the profitability just collapses with a tiny change to an input variable, you have overfit the noise.
Let's use this specific example from the sources to really make this stick.
Okay, take a simple moving average crossover. Suppose you find that setting the moving average to 12 periods gives you fantastic results, great profit factor, low drawdown.
It looks like a winner.
But then, as a robustness check, you test 11 periods and 13 periods. If the strategy that performed beautifully at 12 suddenly produces massive losses at 11 and 13, you haven't discovered a trading edge. You've just found the specific historical noise that happened to coincide with the 12-period cycle.
That's the definition of a brittle system.
Yeah.
It's totally reliant on that one number holding true forever.
It is. A robust system would show consistent, even if slightly diminished, performance across 11, 12, and 13. This sensitivity testing is mandatory for bringing down that DPMO.
What else?
Another powerful improvement is cross-market testing. If your strategy is based on some fundamental market logic, it should ideally work profitably across multiple uncorrelated markets.
Like different indices, or maybe a related commodity.
Exactly. If it only works on the S&P 500 dataset you optimized it on, the suspicion of overfitting just skyrockets.
So beyond these sensitivity checks, what are the final, most rigorous control gates we put in place before we commit capital? The advanced stress tests.
These are the measures designed to deliberately break the strategy in the simulator to make sure we haven't missed any hidden optimization. First, we test against shifted data.
Shifted, right?
You deliberately shift all the entry and exit signals by a few bars, forward or backward. If the profit disappears, the original success was just due to micro-timing lag, another form of fitting noise.
And what about attacking the data directly?
We test by adding random noise to the underlying price data. This forces the strategy to ignore random fluctuations. If the core logic is sound, the added noise should slightly reduce performance, but it shouldn't destroy profitability. If the strategy melts down, it was relying on the data being pristine and static.
That really forces the model to prove its worth.
Absolutely. And the final key checks involve testing against a random strategy to confirm you're actually outperforming chance and running Monte Carlo analysis.
Right, Monte Carlo.
Monte Carlo doesn't change the data, but it rearranges the sequence of your hypothetical trades. If your overall profit is really sensitive to the order in which wins and losses happen, your strategy is too dependent on specific sequencing, which, rarely holds true in the future.
So by incorporating all these steps, the 100 trade rule, sensitivity analysis, noise testing, we're essentially building quality control into the design process itself.
Which lowers our DPMO and raises our strategic integrity. That's the entire point of applying Six Sigma here. It's not about finding the perfect trade. It's about perfecting the process of finding the trade.
And the sources had a really great analogy for this.
A wonderful analogy that sums this all up. Think of applying DPMO to overfitting, like analyzing the reliability of an airplane in a flight simulator.
Okay.
The strategy is the aircraft design.
Yeah.
Every OS test cycle is a trial flight in that simulator. It's an opportunity where a design flaw, the overfitting, could appear.
So if the design team claims they achieved Six Sigma reliability in the simulator, the plane landed flawlessly in 99.9997% of test flights. That sounds phenomenal.
It does. But what happens when the actual airplane is deployed in the new, slightly different environment of live data, and it immediately fails catastrophically? What does that tell you?
It doesn't mean the plane itself is bad. It means the simulator was inadequate.
Exactly. The test environment was not rigorous enough to detect the fundamental brittleness. The simulator was lying to the engineers.
I see.
It means the DPMO for the design validation process is failing. We have to ensure our OOS tests, our simulators, include all these checks: sensitivity, noise testing, shifted data. We're not just validating the strategy, we're validating the validator.
Ensuring the process itself is robust enough to minimize the risk of a financial collapse in the real world. That is a phenomenal way to tie it all together. We started with the silent killer, overfitting, framed it as a design defect, quantified the risk using DPMO based on OAO's test cycles, and then we identified the preventative measures.
That sufficient sample size, the 100 trade metric and compulsory sensitivity testing to avoid brittle parameters like that MA12 example.
The emphasis is all on filtering out random noise and confirming the strategy is truly robust.
It has to be robust against those inevitable slight shifts in market conditions.
And as we wrap up this deep dive, we have to recognize the inherent paradox here. We apply all this immense rigor to fit the underlying stable reality of the market. But the market itself, it isn't a static reality. It's a dynamic, constantly evolving thing.
Which leads us to the final provocative thought for you to consider. If we mandate a minimum of 100 trades for statistical convergence to ensure robustness, what happens if the actual fundamental nature of the market, its structure, its participants, its liquidity, what if that changes fundamentally every 50 trades? If the market stability window is shorter than the window we need for statistical validation, what percentage of a successful strategy's performance can we truly attribute to our sophisticated design versus just the sheer temporary stability of the data we use for OS tests? The struggle for longevity, that is the ultimate measure of quality control.